Welcome back to the channel, and it's time for our November mortgage rate update. I'm going to walk you through what's happening right now with interest rates in Canada, which mortgage rates are getting the best pricing, and how the numbers actually change depending on whether you're getting an insured, insurable, or uninsurable, and if you're buying or refinancing. And I want you to stick around to the end because I'm going to show you where I'm seeing the sharpest rates in the country right now, what the fine print usually looks like on those too good to be true offers. I'm Alex. I work with clients all across Ontario on the mortgage side of things, and I focus on GTA real estate, specifically Oakville and multiplexes. So every month I'm going to break down real rates, real strategies, and real risks so you're not walking into a huge financial decision blind. And if you find this helpful, please hit the like and subscribe button and turn on that little bell thing so you don't miss any month's updates. Okay, so big picture, what changed since last month? And let's start with the backdrop of everything. The Bank of Canada obviously cut its overnight rate to 2.25% after that October 29th decision. Prime rate at major banks right now has lowered and is now at 4.45%. And that's why you're hearing chatter again about variable rates and why fixed rates have been quietly drifting down over the past few months. So let's actually talk about what it means for mortgages today. So who really needs to pay attention right now? There are three big groups that should be watching the interest rates very, very closely. The first one is if you're renewing in 12 months, you should really know what your options are more than you did 6 to 9 months ago. The second group is if you have a rate in the high fours or with a 5 on it and you locked in at those peak rates, there might be a case for a midterm refinance or renewal or just a switch if the penalty math works. And if you're thinking about tapping into some of your equity to do either debt consolidation, renovations, buy an investment property, all of those look different with lower rates and the 2.25% overnight rate than what it was last year or even a couple months ago. And we'll touch on strategy as we go through the rate sheets here. So I just want to back up because a quick definition of insured, insurable, and uninsurable before we throw around all these rates. And let me give you just a 60-second crash course here. Insured, so high ratio mortgages, means you're putting less than 20% down and you're buying under that $1.5 million threshold. Owner-occupied purchases under the insured cap usually means a 25% amortization max. You pay the default insurance premium, which is usually incorporated into your mortgage payment. It's lower risk for the lender, which usually means the lowest rates. Conventional insurable means you're putting 20% down. It's still owner occupied, standard amortization, but the property meets the insurer's rules. You do not pay insurance premium, but the lender can insure the portfolio in the background. Rates are usually just slightly higher than the fully insured, but they're still very competitive. And now conventional uninsurable, this bucket includes things like purchases over the insured limit, so over 1.5 million, refinances, 30-year amortizations, rental properties, second homes. These loans can't be default insured, so they carry more risk and are genuinely higher rates. So keep those categories in mind as we walk through these numbers here. Today's best high ratio rates for a purchase will vary between lender and lender, obviously, but looking at the major broker and rate compensation comparisons, a 5-year fixed insured is roughly 3.69 to about 4% depending on where you go. A 5-year variable insured can be anywhere 3.45 to about 3.89 right now. These are usually full feature A+ lender products if you're dealing with a solid income, good credit, and a normal property. These insured deals are basically the benchmark of the rest of the market prices, okay? These are the best of the best. Now, conventional insurable, again, 20% down, and it's a purchase. If you've got 25 to 30% down payment and your file still fits the insurer guidelines, you're usually in this conventional insurable pocket. A 5-year fixed right now is anywhere between, I'd say, 3.8 to 4.1 for a strong file. A 5-year variable for conventional insurable is often about 0.1 to 0.3 higher than top insured variable deals. So let's say roughly 3.75%, 4%. I'd say just aim for 4. If you get less than 4, take it. But not every lender will bucket this the same way. The more plain vanilla you are to a lender, the better pricing. If you're self-employed, you have stated income, you definitely are going to have a premium, and there's different other factors as well. So conventional uninsurable refinance pricing now are getting into the more expensive money, right? Refinances, rentals, big properties, 30-year amortizations. From national averages right now, the 5-year conventional fixed rate is about 4.69. Now, a lot of refinance quotes fall into the mid fours right now, just under fives, but I have seen a few, honestly, in the last week that I've been working on refis at like 4.14, 4.35, but the discount isn't as rich as insured files, so you can often land in the low fours or mid fours. This is where purchase versus refi difference really shows up. Lenders run special promos to win new purchases and switches and refis. But refis often don't get the same marketing love. So you'll see, again, a 0.10 to 0.30 higher than purchases for specials. And sometimes we do have what's called a whisper special, which is not advertised anywhere. You just have to have connections with good BDMs. What I usually favor are these products that hold solid prepayment privileges. How much are you able to prepay? Offer reasonable penalties if you need to break early, because you don't want to have a huge penalty fee. You want to find products that will let you refinance or switch lenders midterm without nasty clauses, and usually offer more flexibility when life happens, like if a divorce happens or a job change or someone dies, unfortunately. Uninsurable refi might be mid fours, and you're paying for flexibility. These are the headline rates that you often see at every bottom line rate table, okay? But to get that extra little bit lower, that 0.1 or 0.2% lower, lenders might even add a bona fide sales clause, which means you can't break your mortgage until you literally sell your property, which I am strongly against. Do not take that. So blocking you from switching from another term, on paper, you might save $40 a month on the payment, but in reality, if you ever need to restructure your mortgage, access some equity, or chase a better rate later, you might be handcuffed. So just make sure that you read the fine print, and my advice on camera would be something like this. If a rate looks unusually low, don't get excited about it until you actually know what you're giving up to get. And there's a lot of people chasing regret because they just want the absolute cheapest number right now, or cheapest rate. For most of my clients right now, the decision purely isn't which is cheaper. It's how much risk do I want to carry on my monthly payment? You have to figure out what your risk tolerance is and what your 3 to 5 year strategy is. So if anybody is coming up for renewal in the next 12 months at all, like in 2026, if you're coming up for renewal, get a rate hold and some options on the table. If rates drop further, we can just adjust. And if they go up, you're protected. Again, if you're sitting in the high fours or you have a rate that has a 5 on it, run the penalty math and see if it makes sense doing a switch or refinance. And if the penalty is small and you can drop your rate like meaningfully and refinance or switch, it might make sense. See how much money you're saving on an annual basis. But if the penalty is too big, you might just be better off waiting and lining up for the best possible renewal later on. And again, if you're considering pulling equity with today's lower rates, consolidating high interest debt into your mortgage or borrowing for renovations or to buy another investment property, this can work, but only if the cash flow and amortization looks good after. So what does this mean for Ontario and GTA borrowers? Well, for all my Ontario and GTA viewers specifically, insured first-time buyers are finally seeing a 3 in front of the rate. Conventional buyers and refinances are living again in the mid-4s, depending on the quality and the feature. The big lever isn't just what is the rate. It's, are you insured? Are you insurable? Or are you uninsurable? Is it a purchase? Is it a refi? Is it a switch? Are you trading flexibility for a slightly prettier number? Run your risk tolerance on what you want. If you're anywhere in Ontario and you want to see exactly where you land in any of these buckets, reach out because I can run your numbers honestly for free. I will do an analysis for you and run your numbers based off your income, your existing debts, and if you want to pay anything off, the property you're looking at or the property you currently have. So you're not comparing yourself to some generic example from a rate website. And if you found this helpful, please hit that like button and the subscribe button because I will update you on the rates monthly because rates do honestly change weekly. So I'll see you again in a month and we will update you for the December rates. So thanks for watching and I'll see you on the next one.